Lucent Technologies was once a beacon of innovation in the telecommunications industry, emerging from the bell tolls of AT&T in 1996. With a staggering initial valuation of $258 billion, Lucent was positioned as a market leader in telecommunications equipment and advanced networking systems, promising to redefine connectivity in an increasingly digital world. The company's launch was heralded as a successful spin-off, bringing with it the technological prowess of AT&T's research and development. Lucent swiftly capitalized on the dot-com boom, producing cutting-edge products like optical networking systems and wireless technologies, which seemed to promise a bright future. However, this meteoric rise was short-lived, as various internal and external factors led to a rapid decline, resulting in its downfall just 4 years later. Despite the optimistic scenario painted during its inception, Lucent Technologies faced immediate challenges that would soon pose significant hurdles. The telecom industry was undergoing a metamorphosis, with new competitors emerging and existing companies aggressively innovating. Lucent found itself at a crossroads, grappling with the burgeoning demand for broadband technology while simultaneously trying to maintain its footing in traditional markets. It became evident that while Lucent had a reputation for excellent engineering, it struggled with corporate governance and strategic decision-making. The company failed to adapt adequately to the fast-paced changes, leading to increasing operational inefficiencies. As new players like Cisco and Nortel began to seize market share, Lucent's once dominant position began to wane. Financial mismanagement also played a crucial role in Lucent's downfall. In the late 1990s, the company showcased impressive earnings, partly driven by inflated stock prices amid the tech boom. However, as reality set in post-bubble burst, the facade crumbled. Lucent's quarterly reports began to indicate substantial discrepancies, signaling serious issues in revenue recognition. Investors who had once flocked to Lucent started to question the sustainability of its business model, leading to increased scrutiny from financial analysts. The company's stock price, which had soared in its early years, quickly plummeted as these red flags became evident to the market, resulting in significant financial instability. Another factor contributing to Lucent's collapse was its failure to integrate successful acquisitions. Throughout the late 1990s, several acquisitions were made with the hope of accelerating growth and expanding product lines. Notable within this strategy was the purchase of Excel Switching and Optoelectronics. While these acquisitions promised synergy and expanded capabilities, they fell short of expectations, failing to deliver the anticipated efficiencies and integration. The lack of effective post-merger integration coupled with managerial missteps meant that Lucent struggled to leverage these acquisitions effectively, further complicating its ability to compete against more nimble rivals in the telecommunications sector. As Lucent stocks continued to tumble, it also faced declining demand for traditional telecom equipment. The market was shifting toward internet-based solutions, with many companies opting for VoIP technology and other innovative systems. Realizing too late that consumer preferences were rapidly changing, Lucent found its once relevant portfolio ill-equipped to meet new demands. The company's significant investments in outdated technologies became an albatross around its neck. While Lucent attempted to pivot towards more modern solutions, like 4G networks, they were always a step behind the market leaders, who were already moving towards next-generation technologies like 5G. By 2001, Lucent was unable to stem the losses and was forced to announce its first quarterly loss since its inception, sending shockwaves through investor confidence. Layoffs soon followed, as the company desperately sought to curtail expenditures amid dwindling revenue. In a staggering acknowledgement of its decline, Lucent significantly cut down its workforce, leading to a significant loss of morale and corporate culture. The once vibrant atmosphere within the company transformed into one of survival rather than innovation, and this drastic shift undermined the talent and creativity that had initially propelled its rise. In an attempt at a turnaround, Lucent underwent a series of restructurings and strategic shifts. The company appointed new leadership with a focus on revitalization and streamlining operations. However, these efforts were often hampered by an entrenched corporate culture that had become risk-averse and hesitant to pursue bold new initiatives. Furthermore, the looming financial burden, combined with an impending recession in the telecom sector, meant that Lucent's chances of emerging from the quagmire were severely diminished. Despite a valiant effort to recover, the company never regained its former stature. In 2006, the inevitable conclusion came as Lucent Technologies merged with Alcatel in a deal worth $13.4 billion, effectively marking the end of its independent operation. This merger was seen as a necessary step for survival in a rapidly consolidating industry. Although the combined entity succeeded in creating a new telecommunications powerhouse, the legacy of Lucent Technologies was one of cautionary tales. It stands as a stark reminder of the volatility inherent in rapidly evolving sectors like technology and telecommunications. Its collapse raises crucial questions about how companies navigate innovation, market demand, and the economic landscape, emphasizing that even market leaders can falter in the face of dramatic industry shifts. The story of Lucent is therefore not just about one company's rise and fall. It's a reflection of the broader dynamics at play in the tech industry, and the lessons learned continue to resonate today.